On Friday, March 10th, the Federal Deposit Insurance Corporation, or FDIC, took control of Silicon Valley Bank. This incident marks the second largest banking failure in the US history. A bank run, also known as a run on the bank, takes place when a large number of customers withdraw their funds from a bank due to the belief that the bank may go under in the near future. And that is what happened in the case of SVB. To begin, it's important to understand that when you deposit money in a bank, it is not physically stored there. Instead, the bank uses that money to lend it out to someone else. While banks are required by law to maintain a minimum amount of reserves, this amount is typically only 10% of the deposits. This means that the majority of the money in your account statement is actually being used to fund loans and other investments such as car loans or mortgages. The bank earns interest on these investments and uses it to replenish its reserves and fund other operations. However, it also means that only a small fraction of your deposits are actually available in cash at any given time. As long as the depositors don't rush to withdraw their money all at once, the banks can continue to operate normally. However, in times of economic uncertainty or crisis, people may lose faith in the banking system and withdraw their funds together, causing a run on the bank. In such cases, the banks may not have enough cash on hand to cover all withdrawals, leading to a collapse. Now, this is what happened in this specific case. The bank's demise was primarily due to a classic bank run that occurred after indications of trouble surfaced in the second week of March. Silicon Valley Bank accepted deposits from customers and invested them in the US Treasury bonds. However, the Federal Reserve has raised interest rates and the value of these bonds decreased. A side lesson: as interest rates go up, bond prices typically decrease. Under normal circumstances, SVB would simply wait for these bonds to mature. But due to the slowdown in venture capital and the technology sector in general, deposits began to decline and clients started withdrawing their funds. Then on March 8th, SVB announced that it would raise $2.25 billion through a share sale after incurring losses of nearly $2 billion by selling $21 billion of securities from its portfolio. The objective was to strengthen the bank's balance sheet. However, this decision spooked the markets and clients, resulting in a sharp decline in SVB's share price on Thursday. By Friday morning, trading of the stock had been halted, and reports indicated that SVB was in talks to sell. And things got worse when prominent venture capitalist Peter Thiel reportedly advised his company to withdraw their funds from the bank while they still could. And this led to a bank run and the eventual collapse. What a scare. Now here's where the FDIC comes into play. If a bank fails, the Federal Deposit Insurance Corporation, or FDIC, provides insurance for up to $250,000 of deposits, meaning your money is safe if it's under $250,000. However, many larger companies kept a more significant amount of money in SVB. According to SVB's latest annual report, US customers had at least $151.5 billion in uninsured deposits by the end of 2022. Additionally, foreign deposits accounted to at least $13.9 billion, which are also not covered by insurance. But the White House administration took an unprecedented measure by ensuring that SVB's customers would have full access to their money, including uninsured deposits. So, fortunately, customers of SVB will not experience any losses in their deposits. Despite this resolution, the recent turmoil over the past few days has left many feeling anxious, and the stock prices of banks like First Republic and brokerage industry leader like Charles Schwab continue to fluctuate. It's natural to wonder about the measures in place to protect your money if your financial institution fails. So, how much of your money is actually protected? As stated earlier, typically each depositor receives insurance coverage of up to $250,000 per bank. This insurance applies to various types of bank accounts, such as checking and savings account, prepaid debit cards, and certificate of deposit. However, it's worth noting that in the recent incidents involving Silicon Valley Bank and Signature Bank, regulators chose to reimburse depositors entirely without imposing a cap. Unfortunately, there's no guarantee that this will happen in the future. If you hold multiple types of bank accounts in an institution, you should calculate the combined balance to determine if they exceed $250,000 insurance limit. For example, if your $30,000 certificate of deposit and your $25,000 savings account have a combined balance of $55,000, both accounts would be fully protected. Now, what if you have more than $250,000 in your bank account? If you establish a joint account with another person, such as a spouse, both individuals individuals are eligible for a coverage of up to $250,000. As a result, the total coverage for a single joint account could reach $500,000. Another option is to open accounts at multiple institutions. Each account is FDIC insured, and there is no restriction on the number of institutions where you could have accounts and therefore the insurance coverage. In the event that your bank fails, FDIC insurance typically ensures that you will have access to your insured funds within days, often the next business day, provided that your balances are fully covered by the insurance. If another bank takes over your old bank, your money may be transferred to a new bank immediately. However, if your balances exceed the amount of insurance coverage, you may still be able to recover some or most of your uninsured amount. However, it may take years for FDIC to finalize the process as it winds down the failed bank's operations and sells off its assets. But what if a brokerage firm fails? In the event that a brokerage firm encounters financial difficulties, the Securities Investor Protection Corporation, SIPC, acts as a safety net. SIPC is a non-profit corporation that generally covers up to $500,000 of securities and cash for each customer. This coverage can be higher for individuals with multiple accounts, depending on the account types and whether they are individual or joint accounts. For example, a Roth IRA and an individual brokerage account held by the same customer would be eligible for a $500,000 limit at the same firm. However, if a customer had two individual brokerage accounts at the same firm, they would only be eligible for $500,000 in total protection for both accounts. The collapse of Silicon Valley Bank has had repercussions beyond the tech industry and has caused instability in the banking sector, especially among regional banks. This has led to a concern about potential risks to other banks and the possibility of a contagion. The failure of SVB highlights broader factors at play in the technology, finance, and economic sector. Still, in my opinion, it is unlikely that the banking sector as a whole will be significantly impacted by these events. And to be honest, Silicon Valley Bank may have been able to survive if there was no panic. But despite the collapse of these banks, most customers need not worry about their deposits, especially if they fall below the $250,000 threshold. For those with larger deposits, it may be wise to transfer funds between different banks.